Genda okule ziri aku nga bulijjo
Simon, you may share your screen and start for purposes of time, and also the link. The link is short, so kindly start. The rest we'll do in us along the way.
Mr. Katabaz.
Yes, Simon, go on.
Mr. Katabazi, let me use a PC. I was using a phone. Afterwards, so that I can share my screen. I may go out a bit and I come back, Mr. Katabazi. Just a second. Mr. Katabaz. Mr. Katabaz.
Okay, I'm not sure I get exactly what I'm saying. I'm saying, Simon, it's fine, please. Do the info. Okay, meanwhile, as Simon gets ready. Okay, I was saying previously, from our previous discussion that we had yesterday, I showed you guys how we do journal entries from the accounting statements given. I also showed you how we end up with key accounts that are balanced. And I also showed you how we take those balances to the trial balance. Okay, then today we're going to look at the trial balance and end of the year adjustments, where we make the end of the year adjustments and then prepare the statement of financial position and the profit or loss statement. So this is what Simon is going to be looking at today. I hope you guys can appreciate maybe for the meantime as he joins through. Feel free to ask any questions regarding what we discussed yesterday. The recordings will be shared. I'm sure you guys will be wondering, you have not seen the recordings yet. I'm going to be sharing them soon, at least through the Asamu platforms. Then you'll see the, then we also looked at the accounting equation, okay? We looked at the accounting equation, we looked at the journals, we looked at the balancing of the key accounts, we looked at the trial balance. So today we are going to ask ourselves if you have the trial balance and if there are any end of the year adjustments that we shall also look at. How do you end up with a statement of profit or loss and a statement of financial position? And accordingly, he will look at those unique end of year adjustments, things like provision for bad debts, things like depreciation for the year, things like what else? Yes, the closing stock. Okay, he'll be looking at those adjustments accordingly, and we hope you can benefit. So for the meantime, you can kindly be patient as we wait on him. I'm sure he'll be joining in shortly. So otherwise, if there are any questions, please feel free to raise them now. Okay, so that I can respond to those that at least I was discussing for yesterday. As Simon comes through, take you through the adjustments. Any questions you guys have in regard with the beginning part of the accounting? Maybe I also didn't talk about source documents. How we receive cash from okay, where do you get such information?
From Monday.
Documents, from Monday. And also scenarios where we say, oh, we have recorded a sale of 50,000 on credit. Information or proof for that
98%.
that's what we call
98%.
As you join,
kabera kakadi kamu katukuberako buli motoka kikati buli kika kya motoka kebere lore onakubango bobanga bano okoza driving class.
So I was talking about social documents. We have heard of purchase day book, or what they call the purchases journal. Okay, that records all purchases that you make on credit. If as a business you buy goods, they are all recorded in the purchase day book as long as they are on credit. Transactions are on credit. Then we have what we call a sales day book. For it records sales, okay, that we make during either the year or the month, okay, and these are on credit. So we use a sales day book or what we call a sales journal. Okay, then you have what we call a receipt book, or you can call it they call it, I think, cash receipt journal. Then you have the cash disbursement journal. Okay, all those record cash transactions. Okay, if you have made, say, a sale on cash, okay, you sold someone goods and you paid immediately, that's what we call a cash sale. That is recorded in the receipt book. Then if you make any purchases and you pay immediately, or you incur any expenses, we call that cash disbursement book, or you can still call it how can I call it? So it's mainly the cash disbursement book or journal. Okay, so Simon has joined through, so I'm going to issue him the rights so that he can present to us.
Hello.
Simon, now feel free to join through and do the needful. So guys, today we're going to look at the trial balance. Basically, I don't think it's going to say much about it. It's mainly going to talk about end of year adjustments. So Simon, please take over.
Connected.
Mr. Katabaz, am I audible? Hello. Mr. Katabaz, am I audible?
Yes, you're audible, Simon. Please go on.
Good morning, everyone.
Morning, boss. Morning.
How is it going?
The going is okay.
Can you see my screen?
Yes, it's visible.
All right. My name is Kemba Simon. I'm going to take you through the year-end adjustments. Now, to kick off, the year-end end of year adjustments, what does it mean? I mean by the end of the financial year, some transaction took place. In the notes I'm sharing, is someone trying to communicate? Hello. Am I audible enough?
Yes, boss. Yes, boss.
Okay. In the screen I'm sharing, end of year adjustments. It is not possible to keep all accounts up to date at all times. It's true, because at any time there are some errors which could have risen, like there's errors overcast and the undercast errors. We continue. At the end of each financial accounting year, certain accounts must be adjusted by passing entries to represent faithful transactions for the current financial year, and financial statement can then be prepared. In other words, these end of year adjustments include the following: where we're having the accrual and the prepayments, the bad debts and the provision stroke allowance for bad debts. We're having other provisions and the contingencies. We have the corporation tax, inventory, the tangible and intangible non-current assets. We're having that depreciation and amortization, etc, etc. And now, since we are in year one, we are only going to look at accrual and prepayments. We are going to look at the bad debts and provision for bad debts, and some bit of the tangible and intangible, because for tangible, we know it in our balance sheet, they're the non-current. And the intangible asset, we're having the goodwill at any time T. In depreciation, yeah, we are going to look in that also in our balance sheet. Am I audible? If I'm not clear, if I'm not getting anything, please ask. Hello.
Simon, please go on. I'll be trying to keep order in the group. Please go on. We don't have much time on this link, like I already told you. So try to cover as much as you can.
Oh.
The questions will be taken at the end.
Oh, yes.
So just discuss. Then we shall ask for the questions to come through at the end.
Okay. Okay, let me start with accounting for accruals and prepayments. What is an accrual? What is a prepayment? An accrual is a liability, and prepayment, it depends. A prepayment, if it's an asset, we're having these things in form of accrued expenses and accrued incomes, as you can see. We're having accrued expenses. On Roman numeral 3, we're having accrued incomes. Let's read and see. When preparing a statement of profit and loss, in bracket income statement, another name, it can be called comprehensive income, for a specific period, we must bring into accounts all items of income and gains, whether we have exactly received them or not. You remember the principle, the accrual. Did you see? All expenses relating to that particular period, whether we have actually paid them or not, sorry. For this purpose, some adjustments are needed at the end of the accounting period relating to 1. Accrued expenses. What are accrued expenses? These are expenses which are outstanding and not yet been paid. Another name. There can also be called expenses payable. Another name, expenses outstanding. Another name, expenses due to be paid. There are liabilities to be settled in the next 12 months. What is the journal entries for the accrued for the record of accruals? We have debit, the settlement of profit and loss for the respective expense account. Let me say, we're having an accrued electricity. Outstanding electricity is a liability. Are you getting my point? Since I'm having to pay electricity accrued, I'm going to debit electricity account, then I credit the accrued electricity account. I continue. Hello, members. Should I continue?
Yes, you can continue.
Okay. Then if I proceed to Roman numeral 2,
Yes, please.
I'm having the prepaid expense. This prepaid expense, normally in our balance sheet, it's already there. Remember, under current asset, we have got stock, closing stock. We have got the debtors, even the prepayments. Now the prepayments comes in here. Oh, these prepayments, like the salary prepaid, rent prepaid, etc., etc. Their journal entries could be debit prepaid expense account, the current asset I see, and credit a respective expense account. Then if I go to Roman numeral 3, accrued incomes stroke accrued receivables. Now be careful with accrued incomes and prepaid incomes. It differs, somehow it differs from the expenses. Accrued incomes, what are they? This is income relating to the current accounting period but has not yet been received. In other words, another name is income receivable, meaning our accrued incomes, they are assets within our business. Not so, because we are demanding these people, but they haven't yet been given us our money. This is income relating to the current accounting period, but has not yet been received. Our data hasn't received us yet. In this case, the organization has already invoiced its clients for the services offered, but payments are not yet made. Accrued incomes must be reported in the statement of profit and loss for the period. Again, accrued incomes are current assets. Take note of this thing here. This thing, they are assets. Remember, in expenses, an example I gave of accrued electricity. It's a liability because at any time T in the next financial year, I had to pay. But in this accrued incomes, for it is an asset instead to be received and used in the next 12 months, and therefore should be reported in the statement of financial position as current assets. Are you seeing? Then the journal entries would be, just in the case, debit accrued income, the asset, and credit the respective income. Are we together at that point? The opposite is true. The other one of accrued expense, it's a liability. Accrued income is an asset within the business. We go. Remember, we had the prepaid expenses, which were assets within the business, but prepaid incomes are liabilities within. Let's see. prepaid incomes or incomes received in advance or an income. What are they? This is income received in the current accounting period, but relates to the following accounting period. This is current liability. This is a current liability. Take note of this also. This is a current liability on the side of the entity offering a service, and therefore not taken as being earned for the current accounting period. An example I can give here of a prepaid income, it's rent. Remember when you are in case you are looking for rental, as some of us we are looking for one. Mainly it's a must, you have to pay for 3 months. Now the landlord receiving is receiving income, but in him receiving, it's a bit to him because you have paid, let me guess, you have paid January, February, and March. Meaning that the month which you haven't yet slept in, let me say we are in Jan at the moment, the February, March, for you, the individual who's renting, it's an asset because for you will be like, hey, I paid. But to the landlord, he cannot demand it again for the next month because we had already paid the 3 months. Am I clear? If anyone with a question and asks, or I continue. Hello.
Yeah, we okay, we okay.
Okay. Let me go on the bad debts. Remember, we have looked at accruals and prepayments. Then let me look at some scenario where you're having a data. Let me hope you guys did the control accounts. Hello? Are we familiar with control accounts? Hello, guys, are you familiar with the control accounts?
Beginning our online test on the third.
Come again? Hello, are you guys familiar with the control accounts?
Boss, we don't know that one. Control accounts, no?
Okay, but you know a data?
Yes, we know data.
Now, at any particular moment, in case someone is unable to pay you, for example, bad debts on the screen I'm sharing, the bad debts. If it is highly likely that the amount owned by a customer will be received, if it is unlikely, meaning that there are more chances that this person will not pay me. A good example is when you lend someone before the lockdown, you're 200,000, and within this period, maybe he or she is the teacher. They are still in total lockdown. They haven't yet opened them yet. Then it may be a bad data to you because there are higher chances that this guy, this person AB, is unlikely to pay me the amount being given to him before the COVID-19 lockdown. So if it is highly unlikely that the amount owned by a customer will be received, then the debt is known as irrecoverable or bad debt. The normal entries to record the bad debts written off will be debit bad debt written off, then credit the receivables or debtors account. Now, for instance, in the case, let me say that this company was a little bit wise, it provided for some allowance, stroke provision for receivables, stroke debtors, means you are now providing for debtors. Let me say you in a company, you had your 5 debtors. Among the 5 debtors, only one is a bad debtor, meaning is unlikely to pay you at any time T. Then the company may be the board sat and is going to put money aside. A board is going to put a money aside for you to cater for these bad debtors, to cater for these debtors. Let me say not bad debtors, to cater for the debtors, just in the case they haven't yet paid. Now let's see. Means that possible loss, allowance, or provision for receivables or debtors means that the possible loss is accounted for immediately in line with the concept of prudence. Remember the prudence concept, the principle? The amount of original debt will still remain in the ledger account just in case customer does not eventually pay. When, let me say the company is providing much. For example, I can give a scenario here. Originally the debtors, they were 5. But now the company is going to provide more. Let me say that total amount for those debtors within the company, they are 5 million. The total income which we would have got when those debtors, all of them have paid, is 5 million. But there is one whom you know is unlikely to pay me, is a bad debtor. And these other ones are going to provide 4. 1. Now, if the company provides 8 million to cater for the debtors within, I get my point. Originally, there are 5 debtors whom, if the company received that money, it would have been 5 million. But now the company is providing 8 just in case. Now it's providing more, meaning that the business is losing money within the business. Are you getting it? So when provisions increase, when you provide more, you see, we are having debit, bad debts, or irrecoverable expense with an increase. You get the difference, and you credit the provision or allowance for bad debts account. Are you getting it? Now remember, this one now becomes an expense. Always when a provision increases, it's an expense. I proceed. When provision decreases, let me say, originally you in the previous time, let me say the debtors were you are owing them 50 million, and you provide just less. You say, let me provide 20. I get it. The total amount for all the debtors was 50 million, which in the case these debtors pay, you are going to receive your 50 million. But for you to cater for unlikely circumstances, you are only going to provide 20, meaning that you are leaving much money within the organization, within the business. Now, when a provision decreases, it's an income. That's why it has to be added within the income statement under other incomes, and you add it in gross incomes, so that the journal entries will be debit provision stock allowance for bad debts account, then you credit the bad debts or recoverable, just in case you are journalizing. With the decrease, you just get the difference. With the decrease here, just in case, as we shall see in one of the questions, that in the trial balance they may have provided in the previous year, and now you will be, let me say, in the previous trial balance, they provided amount, and then in this current year also providing. You get the difference, how much you provided in the previous year plus the additional to get the decrease and an increase. I continue. There may be bad debts recovered. Like example, for the moment, he may not be able to do what? To pay. But at any time T, he may may pay in, for at a later stage. Let me say in the next year, the schools will be open officially. Are you getting it? If he pays, now you write him or her off within the bad debtors and B, bad debts recovered, because he has paid his or her liability at that particular moment. So bad debts written off previous periods may be recovered in a subsequent accounting period in some cases. The recovered dates are regarded as a gain, true, because now the business for it will be gaining, and the other person paying will be losing. But for us, we are particularly looking at the business itself. Allow me to go to the questions unless someone has any addition to add on or anything he wishes to ask. Should I proceed?
Yes, you can proceed.
Let me hope you are understanding, guys.
Simon, maybe shortly, since you're going to attempt a question, I would advise that for now you stop here. The link is going to expire anytime soon. So I'll wish a new link, then you start with a question. But maybe shortly I can add something. We have talked about accruals and prepaid. Okay, usually accruals and prepayments, we're looking at incomes and expenses strictly. So we have accrued expenses and prepaid expenses. Just like we have accrued incomes and prepaid incomes. Now for an expense, if it is prepaid, like Simon has been explaining, it is a current asset. Why is it the current asset? Scenario is if you say renting a house. If you pay some few months ahead, okay, pay some few months in advance. Sometimes, by the way, it's called payment in advance. What you call a prepaid expense. If you make if you pay an expense in advance. Now, what happens is you're going to be living in this house without making any other payment until the 3 months end. So, because you're living in a house that you're not going to be paying for the next 3 months, reason being you paid earlier what you're calling a prepaid rent or prepaid expense, that qualifies it to be a current asset that you'll be enjoying the fruits of what you've already paid for. Okay, then accrued expense, just like I've said, it's an outstanding expense. You're staying in somebody's house, okay, as in you're renting, and you have gone 2 months without making the payment. So when you go 2 months without making the payment, that you have an outstanding expense. You have a debt to pay. You have a liability to pay. So for prepaid, for accrued expense, it's a liability. So in the same way, just like I've talked about the expenses, even the incomes, for them, they're the opposite of the other. But when we talk of prepaid income, they're saying you have received money before you issue a service. Okay, if it's in terms of rent, you're the landlord. Okay, you have received rent money before you make the what? Before the guy lives in the house. So meaning that to you as a business, it becomes a liability. Okay, that you have received somebody's money before you give him a service. So that's what we call a prepaid income. Okay, then for an accrued income, what happens is you have already issued a service as a business. Okay, if you're talking about landlord and stuff, the man, you have allowed the guy to live in your house, okay, but he's not paying or he has not paid yet. So that's what we call accrued income, that is going to pay you in the end. So that qualifies it to be an asset. Okay, maybe something about bad debts recovered. What happens with the bad debts recovered? The issue is that you wrote off these bad debts in the beginning. But once you realize that this is a bad debt, you wrote it off. By writing off, of course, he has explained, you debit bad debts. That means you're recognizing an expense. Okay, then you're crediting the debtors account or the receivables account. A reason being that you're not going to be expecting money from them anymore. So your assets have to reduce automatically because of the bad debt. Now, should it happen that somebody has come through, okay, the person that you declared a bad debt has come through to pay you, what happens is you first reinstate the debt, okay, by crediting bad debts. Okay, by crediting, of course, you're reversing a transaction. I'm talking about that transaction that you're seeing under bad debts, just 3 lines below. Then they're saying debit bad debts and credit receivables or debtors account. When a bad debtor comes back to pay you money, remember you had written him off. You're supposed to recover that. You're supposed to rewrite or reinstate the fact that he's a bad debtor. That is a debtor. So in reinstating, we do the reverse by crediting bad debts and debiting the debtor's account. Okay. So then, whatever amount he brings through, if he has made a full payment, for example, then accordingly you debit your bank or your cash because you have received the money. Then you do what? Then you credit then you debit the bad debtors. Debit is credit. Then you credit the bad debtors. You get? You debit the bank because they received the money, and you credit the bad debtors because they are being reduced. Okay, the key item here is reinstating that part. If you don't reinstate, you're not going to be corrected with bad debts recovered. So I hope I've explained a little more. Maybe if Simon have gotten anything from that, maybe I can talk about provisions. I'm not trying to repeat. I'm just trying to each time so that the link can expire. Then we issue another link where he will be continuing with the question. So maybe briefly about allowance or provision for bad debts. Usually, this whole thing comes from the prudency concept. That as a business, you're going to recognize incomes as they happen. Okay, then you're going to recognize a liability, okay, as there's a probability or chance for it to occur. That's a prudency concept. That you look at yourself and you say, now like the bad debtor, you're saying it's an asset, yes, but is there a chance that they're not going to pay you? Once there's a chance, once there are things like maybe you've been following up on this data, you've been making calls, and maybe for some reason the guy is not answering, he's not responding. Okay, when you check his books, his accounts are not doing well. When you make such, when you find out such things, as a prudent person or as a prudent accountant, you begin to accept that clearly I'm not going to receive this money. Hence, you realize or you recognize the what, the loss. So that's how we end up providing for bad debts. It comes from the prudency concept. So when you provide for bad debts, what happens is if it's the first time, you will debit or recognize the expense by debiting provision for bad debts, and then you credit provision for bad debts account. There's a difference there. Okay, debit increase in provision for bad debts and credit provision for bad debts. The provision for bad debts, it's more of a liability account, but it's not really liability because it does not sit on the statement of financial position or the balance sheet. You don't find it there. Rather, they subtract it from the receivables account, okay, come up with the net receivables account. So what am I trying to say? I've explained where the thing is coming from, the prudency concept. I've explained that if it's your first time, once you provide, you're increasing from 0 to something that you're